believed about successful buying, selling, and financing your home was wrong. Welcome to Homewise with Miget. This is where you can count on straightforward, objective advice on the right way to make the most out of every dollar you put into your home. Whether it's buying, selling, or financing, even maintaining and growing its value along the way. Coming to you from the News Talk STL studios at Union Station in St. Louis.
You're listening to Homewise Radio. I'm Stal Ponticus, and I'm joined by the creator and host of the show, Michael Miget. Michael, good to see you, my friend.
Hey, Stal, how are you?
Doing fine, thank you.
We've got a barn burner today, let me tell you. So, coming off last week's show, that was a big one.
That was fun last week.
Stung some, we touched a nerve, I think.
Good.
So, and rightly so, because it's just, it's not, I wasn't guessing with that. I know just from dealing with people what they are sensitive to, what they're not, and that is one of the things they are sensitive to, the buying and selling of their credit information and used for marketing purposes, and they don't know why. So, causes a lot of confusion, but today this is probably the ultimate confusion that I've ever seen with regards to a story in my industry, an industry which, it's mortgage and it's real estate, right? So, how much can there actually be there? It's not a subject that is very electric, like if you're reporting the news. Well, today we have some news to report. You might just be hearing about it for the first time. You might have been hearing about it for a few days, but it's the mortgage fiasco debacle about who's getting charged what and why and who's paying more and who's paying less, and it doesn't make sense. And we're going to sort all that out today. But to make a long story short, rates on some borrowers are going up. Rates on other borrowers are going down, but it's not the ones that you think would be going up or down. Doesn't make sense. So,
okay.
There's a ton of confusion on this. Anything from just, we'll give them the benefit of the doubt and say it's sloppy wording or a headline written to garner interest, clickbaity kind of stuff, all the way up to downright lies. Okay. So we are going to tear into this today. I've studied the changes myself. I've been looking at them for a while. I have not dug into them as deeply as I did in preparing for this yesterday because we've been fighting this at an industry level. Mortgage brokers, mortgage bankers, mortgage lenders, banks, credit, everybody is fighting this. What we are going to talk about today, most of what you have heard revolves around credit scores and down payments as affecting what you're going to pay. Truth is, that's only half the story. There's a whole nother grid of things that are going to affect what you pay. One of those things we actually have successfully gotten pushed off, not killed or squashed, at least not yet, but pushed off, and that was the debt ratio. So there was going to be, remember how I would say that debt ratio used to be a pass or fail test. There was no effect on your rate as far as what you were going to pay based on if you had no bills and a very small mortgage payment compared to somebody that just barely squeaked under the wire and qualified. It's a pass or fail test. Everybody pays the same. Not true anymore. There is a point at which you're going to pay surcharge. We just call it a surcharge at this point, but for having that higher debt ratio, it's on a stay, right? Like a stay of execution. It's been pushed off. It was supposed to go into effect. It has not gone into effect. If you think this is confusing and going to be difficult to implement into the pre-approval process, that further complicates things. So it's good news it's been pushed off, but just to let you know, we are fighting this, but part of me bringing this to you is just, again, we see what we see in the news. We hear what we hear. When we're not an insider, we don't really know what to think. And just a lot of the headlines are misleading, to say the least. Some of them are false lies, and we're gonna tear that apart. Okay, so what are we talking about here? Again, long story short, possibly the worst time ever this could happen. Rates are going to go up for some borrowers. All right. Most conventional borrowers will say, all right, compared to what they were a few months prior. All right. So also let me say this affects conventional loans only, not FHA loans. All right. So if you remember, FHA got a price decrease in the form of reduced mortgage insurance premiums. The required mortgage insurance, the monthly, got cut in almost in half a couple months ago. Winds up being a big reduction for FHA loans. This is only for conventional loans that are delivered to Fannie Mae, Freddie Mac. All right. So when a loan is delivered to Fannie Mae or Freddie Mac, there is a fee attached to it. All right. The borrower doesn't pay that fee. It's the fee that the lender that sells that loan into the pool has to pay. That fee is based on the characteristics of that loan. All right. So there's a lot of characteristics that feed into that, but let's just focus on two to keep it as simple as I possibly can. Credit score. Okay. So last week we were talking about credit scores. Last 2 weeks we've been talking about credit scores. So credit scores feed into that, and basically how big of a down payment. If we're talking about a purchase money loan, right? Down payment, it's the your equity position in the property. Generally speaking, the better qualified you are, okay, the less risky your loan is, your rates are generally going up. All right. And conversely, lower credit scores, lower down payments, loans that are considered more risky, those rates are going down compared to what they were before. Okay, now let's stop right there and let's take a step back. What you will see reported out there simply states rates for higher credit borrowers are going up and rates for lower credit borrowers are going down. Okay. Generally, that is true if you look at it in comparison to the previous rates, right? So I just said that when a loan gets sold into a pool, there is a fee associated with it. The fee associated with higher credit scores and larger down payments is going up more. Well, they're going up, all right, but they're going up more than the fees associated with the lower credit scores and the smaller down payments, which sounds backwards, okay? We're going to talk about risk-based pricing here again in a minute. Sounds like a complicated concept, but it's not. It makes total perfect common sense, right? Which if you apply total perfect common sense to this subject, you will come to the same conclusion that myself and everyone else in my industry is like, what the hell's going on, right? So, and for the icing on the cake, right? So you thought that was bad? Okay, so there's more here, all right? If your income is below the average median income for the county of the house that you're going to buy, looking at buying, then the fee associated with the loan when it gets sold to Fannie Mae gets waived. All right. So what does that mean? That means that if you make at or below the average income, which here in St. Louis County is like upper 90,000s. The exact number escapes me, which you can find it online. It's like 90. Let's just call it a little under 100,000. All right. So if you make under 100,000, you can get these all waived. All right. Which can be a big deal. If you make just over that or way over that, then you have to pay these fees, right? So the fees can range anywhere from, on the low end, about a half a point on the loan, all the way up to upwards of 2 to 3 points on a loan. All right. Now, something else you will hear reported is, and actually you don't hear this reported, you'll hear it left out because when they say that rates are going up for better credit borrowers, are going down for lower credit borrowers, they're talking about the comparison. Okay, now, but overall, it's still, if you have better credit, you're going to pay a lower rate. All right. It's just that the spread between having good credit and less than perfect credit used to be enormous, gargantuan. Like there was a point where you would stop looking at conventional and you would go to FHA, right? So that's why that break even, that that break-off point exists. We've talked about that on the show before, which you can catch all the previous episodes at homewiseradio.com or wherever you get your podcasts. Anyway, so those break-even points used to be about 680. All right. I don't know where they're going to end up now because there are so many variables coming in there. We literally have to look at loans on a case-by-case basis to be able to tell where somebody should be. So now more than ever, it's important to have somebody that's experienced, somebody that's going to do an analysis, somebody that knows the ins and outs of this, somebody that has your best interest at heart, somebody that's just willing to do the work and gives enough of a hoot to put themselves in your shoes and do what they would do for you that they would do for themselves, right? That's the way I like to look at things, by the way. We're going to have a guest in our second segment today, and I will generally only work with people, my partners, that do that same thing, right? So they all have my full trust. We are going to explore all of that. But, when you sum all this up, it just doesn't make sense, right? What's going on, all right? Well, it's not that complicated. Okay, now the news can complicate this immensely, but let's keep it simple. All right, it's a money grab. Okay, they need money just like everybody else does. Okay, so you've been hearing about the worst real estate market in 20, 30, 40, however many years in the story that you're reading. Right, it's true. It's bad. It's as bad as it's ever been since we started keeping track of this stuff. Sales are down, prices are up, affordability is down because rates are up, prices and rates up, income's not keeping pace. That affordability formula, which we've talked about before, it makes it difficult for people to buy. So fewer deals are getting done. So that hurts the people on the front lines, right? So the real estate agent, it hurts people like me. It hurts the intermediaries like the wholesale lenders, the banks and the credit unions and that. Well, it also hurts the agencies, Fannie Mae and Freddie Mac, because they are in a business. They're not for profit. They make money by creating these pools. If they have fewer loans coming into the pools, they're not generating the revenue that they were generating before. So there comes a certain point where, hey, we have to generate more revenue. How do we do that? We need to raise our prices, okay? So when they go out into the pools and they look at, okay, well, how can we best do this? Well, maybe they left out the word best. I don't know, but how do we do this? What did they do? And when it's, okay, we need to raise costs. We need to raise prices, which I don't like it, but I don't have a problem with that because that makes sense, right? You can stand behind that. The problem comes in when they say, okay, who's going to pay more? But only you are going to pay more. This other group is going to pay less. And when you look at it, it's the group that is paying less that was paying more before, meaning the lower credit qualified, the smaller down payments and all that are being favored now, or maybe we should say penalized less now than they were before. People with better credit scores, people with larger down payments are being penalized more than before, right? So in some cases, upwards of almost a point more, which is enormous on a loan. I mean, it can be on the short side anywhere from 1/8 to 1/4, maybe even 3/8% on the interest rate. And that translates, depending on what your loan amount is, but that can translate anywhere from $30, $50, $60 a month. Well, I see people make borrowing decisions based on $40, $50, $60 a month. Now to have that payment artificially, I say artificially because this is not market-based, this was a decision this is legislation. They've just willed it into existence. They decided to pass this or whatever. It wouldn't have to be done, but they're doing it. So anyway, just real quick, the risk-based pricing, it works like this. It's simple. The ones who pay for the ones who don't. Okay. So if you're going to give one group a break, you have to take it from somewhere else. All right. When it comes to credit score is really the thing that enables risk-based pricing to happen. It's the quantification of risk into a number that can be applied uniformly across a group of loans. Higher risk loans should have higher rates for them. Lower risk loans should have lower rates for them. Why? Well, one, because it makes sense. But see, the way the math works out is when you have riskier loans, they're riskier. The result of them being riskier, they're not riskier because we said they're riskier because we looked at the performance of those loans. And the performance of those loans, meaning the people who pay and the ones who don't, dictate that these default or they're delinquent to a higher degree than the other ones, right? Than the less risky ones. They're less risky because they're not delinquent to the same degree. And then when you look at, these generally have better credit scores. These generally have larger equity positions or have made larger down payments. Therefore, we look at those and we see less risky buckets. So when it comes to the way you're going to price that loan, one, you can afford to give them a better rate because you don't have as many who aren't paying to pay for by the ones who are paying, right? So there's more people paying, there's less people not paying. There's just less there's less dead weight there to carry, right? So they can afford to have that. But there's also another thing, and it's you got to dig a little deeper for it, right? And it's kind of the issue that I have with most of this has to do with encouragement. Okay. When first-time buyers come into the market, people who haven't bought before, people that want to know, how do I get the best rate? How do I get the best deal? How do I do this? Like, how should I go about this? Keep a good credit score, save up money for a down payment. That's how you get the best deal that you can. So people have been incentivized to do that based on the way the system was, right? That helps to reduce risk overall. It helps us to avoid things that happened 15 years ago, like the 2008 crisis, okay? So now to come along and that whole deal's been upset now because if you look at the grid, you're not penalizing, at least to the degree that before, the people that fall into those riskier buckets for whatever reason are not paying their proportionate share of the risk that they bring to the pools. Mm-hmm. The point of all that is to try and get more people into the housing market, to do things that are good for that group of people. And don't get me wrong, I'm all for that. All right, I love to promote home ownership. I think that it's good. I like to help less fortunate people. I want to do what I can for them without hurting them. Okay. But more importantly, I want to do it without hurting the other people, right? So the better credit, the larger down payments, which form the foundation of those loan pools, the bread and butter, if you will, the middle, the solid middle, the ones that make everything else work, the ones that make everything else work out. And so if you raise their costs, some of those people are going to not show up.
Sure.
To buy,
yeah.
Right? So I can tell you right now, there's people out there who finance because it makes sense to finance. There's a point at which it does not make sense to finance anymore, mathematically, spreadsheet on a piece of paper. There's another group of people out there that will just say, well, that's BS. I'm paying my loan. I'm out, because that's what they believe. So there's Murphy's law, the law of unintended consequences, right? We're going to see how that's going to play out here. All right. But let's go to break.
Okay.
And we're going to tie this together, see what's going on in the real estate market and make some predictions on what we think is going to happen there. Okay.
Okay. We'll take this quick break. You're listening to Homewise Radio. I'm Stal Ponticus. That's the creator and host of the show, Michael Miget. And we will be right back in a moment. You're listening to Homewise Radio. Welcome back. I'm Stal Ponticus, and I'm joined by the creator and host of the show, Michael Miget. And Michael, we've got a special guest. Your chance to do the introduction here, my friend.
We do, Stal. We do. We are back to having guests on the show. Welcome, Angie Wilder.
Thank you.
Back to the
Thanks
show.
for
You've been
having
on
me.
here before. Hey, you're welcome. Angie is with Realty Executives. And why don't you give us your contact information at the beginning here, just so that who knows where we're going to go.
Okay. So my name is Angie Wilder with Realty Executives of St. Louis. I've been in real estate since about 2012. So I wasn't
So a long time.
around for the crash. But my cell phone number is 573-579-6548. And my email address is angiewildersells@gmail.com.
And I just usually go to angiewilder.com because that's about all I can remember.
There you go. Hey, if it makes it easy enough, sure.
If it works.
Yep.
Well, there's all kinds of information there, so you should go check it out. So, so this is a hot topic today. It's
Yes.
a big deal. This story's blown up all over the place. And for the most part, the headlines are getting it wrong. I want to know how that is going to play into the market here, especially locally. But bring us all up to date on what is actually going on in the market now.
Well, right now it is very busy. We are seeing listings starting to come back on market, whereas inventory got very low in the fall and winter months. There are buyers ready, willing, and able to purchase, just not enough inventory out there for everyone.
Right. So there's a lot of buyers.
Right. Just to
Qualified
give you
buyers.
an example,
Right.
I had an offer out yesterday, 17 offers received on one house.
So we're still looking at multiple offer situations.
Absolutely. And I don't think that's going to change through the spring and summer months.
Yeah, it's supply and demand, and so prices are not going to come down until that balances out. So it makes
Right.
sense. It makes sense.
And I mean, right now I have a handful of buyers looking, and
So are they like? What are they? Do they skew towards any part of the market, like first time versus
I have a couple first-time home buyers. I have a couple relocators, and I have another couple who already own a home and are just moving up, getting bigger.
So it sounds like evenly spread across the spectrum. Just people want to buy.
Yes.
So.
So who wants to sell?
Well, right. So we need houses. So folks, if you are thinking about selling and you're not sure, or you don't know how it works with, if we sell, we got to move, and like all that, it makes more sense to call and talk to a professional. I personally have worked with Angie on numerous deals where we have done that carefully orchestrated thing.
Buy and sell. Together simultaneously.
There are a dozen different ways to do that. In fact, one comes to mind that was particularly complicated, but where they needed to sell.
I'm not sure it's ever easy.
Well, right, yeah. Sometimes I have this nasty habit of replacing simple and easy together, right? Are uncomplicated. It's simple to understand, not easy to do. So, but there was one where they moved. They really needed to sell in order to move, so we had to do a bridge because that's where their cash was, right? Mm-hmm. But the house they were moving out of was not ready to sell, and they were in a position where they didn't have to put it on the market to dump it to get something, they could afford to
wait a little and do it right.
Yes. There was, some simple repairs, but things that you wouldn't want to put a house on a market without doing, so they could get top dollar for it still, because it's a good market where you can still get top dollar. Where they had to, so it was a move, fix up, sell, then take proceeds, pay down, and recast over the course of a few months. And it sounds easy now that I just said it like that. And as you're putting that together,
I don't think those pieces are ever easy.
Yeah, they're not. Well, because most of that falls on you. I mean, honestly, it's the realtors that make that happen. I mean, my job, it's not easy or simple, but that is definitely spinning multiple plates, juggling, different things. So that's a big deal.
But it can work. And I think that scares a lot of people going in.
It does.
But it shouldn't. You should call someone, have the conversation. That costs nothing.
Exactly. It's the fear of the unknown. Mm-hmm. And you don't know what you don't know. Or worse, you're talking to your brother-in-law, your neighbor, and they, oh, no, that's not, you got to do, like one of those things. And so
I know a couple of those people.
Yeah. You get this idea in your mind that, from somebody, they were sharing an experience that, was probably accurate, but it may not have been the best experience because maybe the person that they were working with or group that they were working with weren't experienced or didn't handle it as well. And I'm trying to be nice about it because I don't want to throw anybody under the bus.
It can look easy, but it takes a fine science. You have to determine what's needed for the house that they have to sell, how much time you need in between, how long is too long, how long it's going to take to sell the house. You have to put all those factors together.
Yep. And so now we have this increased complication in there. So we already... we have a lot of buyers in the market. We're struggling to get sellers. Prices are still up, right? Well, guess what? Rates are still up, too. And as we just talked about, they're going up. Right? Well, actually, if you have been pre-approved or priced within the last month or so, your guy gal may not have told you this, but that pricing hike has already been figured into because it's for loans that are delivered after May 1st. That means delivered to the agencies, not closed or anything, but the loan delivered. There's a lag time between when a lender closes a loan and when they package it together with the other loans and they deliver it. So they've been adding these charges on for about a month or so. Okay. So it's new, but it's not like that new. I've actually referenced this a few times. I just thought, we were successful in getting the debt to income thing pushed off. I thought we were going to get this pushed off also, at least a stay, push it. But especially given the market, right? Because it hurts affordability. It makes it harder. So we're talking about this orchestration of these, complicated moves or people, they need to get pre-approved to do this. Higher rates makes that harder to do.
Absolutely. It can sometimes raise a monthly payment, by several $100s.
Good.
And that can knock people out of the running for that price point that they're looking for. Everybody wants move-in ready. They don't want to have to come in and make any changes. They just want to move. And a lot of times, they have to start looking lesser than what they're fully approved for because we are competing. So you have to be able to show up.
How do you, because that's a huge point, is being able to compete, because just like you said, 17 offers on a house, and maybe that's an outlier, but to hear at least multiple offers, like more than one, like if you're going to make an offer on a house, you're not the only one, most likely. If it's a house that's like you want, other people are probably going to want it too.
Sure.
How do you be competitive?
There's so many ways.
Okay.
So just from an agent-to-agent standpoint, I contact the agent directly, not via text. I give her a call,
so
him
it
or
could
her
be who
a
you
call.
know, too.
Yeah.
Okay.
I become friendly. And if I don't know the agent, obviously I call more and I ask questions. And then they are familiar with me once I do deliver something. So I feel like that is a huge game changer. So you need someone who's willing to communicate.
Yep.
I mean, aside from contractual agreements and terms that you're putting in and offering the sellers, that's a huge thing, because then they start advocating for you on their end.
Right. Right.
So there's one. Obviously, terms, financing terms, the strength in financing. Inspections is a big one that has been kind of teetering lately in a big controversial way. How do you buy a house that's $300,000 and not get an inspection? You don't. You get an inspection. But then are you just walking in, allowing the seller to walk away without having to do any repairs? Possibly.
Right.
Right now.
Right. So you're using the inspection to kind of identify a catastrophic defect in a house
Yes.
that would make you want to walk away from the deal. But you're not using it. See, there is a way that you could use an inspection like that as a negotiating tool. Right.
Oh, absolutely.
Yeah. So.
Oh, sure.
I mean, in a non above board way, like, because I've seen people do it with appraisals, like an offer. You offer something, the house isn't going to appraise out. So you got the appraisal writer. So, we just offer some crazy amount to win. Then we get the seller locked in, and sellers never want to put houses back on the market. Like a house back on the market, it's no good. So they wait for that appraisal to come in low. Oh, look, the appraisal came in low. Now we got to bring the price down, and so
well,
it's
there
like,
are a lot of very
shady.
knowledgeable, good agents that would not just allow that.
Sure.
So
right.
if you have a good agent, your agent will tell you, we have this great price, but then we have this appraisal writer as well.
Right.
I mean, are they putting appraisal gap coverage in, or are they waiving the appraisal? Sure, that number looks great, and you're seeing stars and you're seeing dollar signs, but in the end, the appraisal writer will stop that from happening. So, do they have the funds to back up an increase? If we go back and we negotiate that.
Right.
So you have to keep that in mind as well.
Mm-hmm. More?
More?
I always want more. Come on. No.
Well, well, that's just based on your comment.
Right. No. The thing I was going to say, and this is huge because it comes up a lot, is the communication piece. So you had mentioned reaching out through more than text, like in a personal way.
Sure.
To deliver that offer.
That endears another human being to you. I mean, I wasn't the number one highest offer in that 17 group, but I did receive a phone call saying, we've been talking this whole time. I really feel like your guys would be great for this house, but they'd have to do this. And in the end, we couldn't.
Right.
We couldn't go that far out of their means.
Right.
However,
but you knew
that
about
just told me that I was doing the right things.
Right.
For my clients and representing my clients the best I could. And they saw that as well.
Right.
So they, didn't want to pass up on that, but they came to the realization that we will find the one for them, and I will always advocate for them. So.
Yeah. That it makes me think of a case recently where it was the seller was worried about, tying up the house, just what I said with a borrower that's not, the pre-approval is not worth the paper that it's printed on. He told me, and I go, I get it, right? I get it, because you don't know me. You don't know who it is. You've had bad experiences before. It was an institutional seller, and talking to this person, and I said, look, I get that. I agree with you, but I'm on the phone. I'm talking to you. I'm telling you face to face, through the phone, face to face, that this is as solid as you're ever going to get for this, right? So this is my reputation that I'm putting on the line with you. I'm giving you my word. It's not a guarantee. I can't promise you that they'll close because I don't have a crystal ball. I can't see the future. But what I can tell you is that this wasn't just something that was like cranked through a line and done in passing and we're going to figure it out later. I've done all the work on it already. We're as solid as we can possibly be at this point. You know, the wild card in this is the house. Is it going to appraise out? What's title work going to look like? Things like that.
So are you able to, so I've been seeing it here, there, and everywhere as a seller's agent and also offering as a buyer's agent, getting these folks fully underwritten and waiving financing.
You could. It's, you know, it depends on what you are going to want to protect yourself against. I mean, honestly, with with all of this, right? There is no, loan contingency date comes around and there's like a signal going off in the background that looks at, okay, show me what you got, and it's like your homework is due, right? Oh, you're not done. You're failed. Now we're on to the next one. Loan contingency date comes around for whatever reason. Let's just say that I didn't have it final, underwritten, finished, ready to close, right? Because the appraiser took 3 extra days and we were tight on the time frame anyway. And we just, we have plenty of time because there's a week left. We've got more than enough time, to do all this, but are all the T's crossed and are all the I's dotted? No, right? But I can see everything. I've got everything. It's all in. We just have to finish the paperwork. I'll issue loan commitment, right? Even though the underwriter has not issued final on it yet. I've got that, or maybe the clear to close. We have final, but not clear. I mean, this is industry jargon, right? But there is no like your homework's due and you have to show me what you got. It's, are we good?
In
so
some
that date
cases,
can go by, yeah.
In some cases, I will say, so I currently have a deal where the seller is purchasing a week prior. He was fully underwritten, but we went about $10,000 over. He has those funds just in case. Mm-hmm. However, we're closing on his home a week later. So our loan commitment for his sale was yesterday. So the lender told us if we could produce the loan commitment letter and the commitment to lend and move forward, that that would change his debt to income ratio, the DTI, and he would get that additional 10. So he wouldn't have to use those funds, which is a huge deal to him.
Right.
So that's why we requested a formal loan commitment letter.
Right.
So.
Yeah, and sometimes they need them, but the point is it's not like the closing date is you got to show up, right? You got to have something there on that. Sure. The loan commitment date is more of a, it's like your parachute, like your ripcord date. Like this is your last chance to bow out.
I always tell my clients that it's the lender's due date.
Yeah, exactly. So
is this a good spot to take a break here?
Yeah, we will get. Can you stay around?
Can you stay with us,
Sure.
Angie?
I've got
Good.
more I want to ask you. Go to break, and we'll be right back.
Okay. You're listening to Homewise Radio. I'm Stal Ponticus. That's the creator and host of the show, Michael Miget. Angie Wilder is here in the studio with us, and we will all be back right after this quick break. Welcome back to Homewise Radio. I'm Stal Ponticus, the host and creator of the show. Michael Miget is here with us in the studio, along with our special guest, Angie Wilder.
Very special.
And you're doing a great job, Angie. It's great to have you here in the studio.
Thanks, Stal.
And Michael, continue the conversation.
All right, we got a good one here today. So, in case you haven't heard, rates are going up, right? So, inflation, yep, it's still there. Market-driven factors making it still go up, but now we've got the artificial factor of hey, we need to raise more revenue for the loan giants. We got to raise the rates on people effectively, done through increased fees, but that ultimately translates into a rate increase for people. Not proportionately applied across all people that borrow money. So it's encouraging what some have said is more risky lending and borrowing, and disfavoring or discouraging.
I like how you got there.
Less risky. Yeah, sometimes I gotta feel, hey, you know what? We're just some days we're just hanging by a string here. No, it's just it's not. This is complex, right? So, my eyeballs are spinning around trying to completely wrap my mind around this to be able to simplify it to a point where you could actually talk about it with regular people, right? And then there's a further complication that we're doing it on the radio, right? So even though you can watch us on the radio, I don't have a whiteboard here where I can draw on it, because if we were meeting face to face like I do sometimes with people, we could do that. I could show you stuff, right?
It's easier to relay
exactly.
because it's visual.
Exactly.
Yeah.
And I'm a very visual person, so that tends to help out. But one of the things that I have come across, a question in my mind, has to do with the way that the increases are being applied across the full spectrum of borrowers, the way that some are being rewarded and others are being penalized, right? And sellers generally want more qualified looking borrowers, right? So they prefer a conventional approved buyer over other buyers, we'll just say. I don't always agree with that. In fact, I almost never agree with it, because it's not an accurate dictator of the likelihood with which a deal is going to close, but it's perceived that way. All right. But so something I haven't not said yet, just because we just didn't get there, is that, so I already said that lower credit scores, they're paying more, but they're not paying proportionately more compared to the better credit score people. When you go into the other piece of that bucket, which is the down payment, so the 20% down payment people, which I said they're the ones that are bearing the largest brunt of, actually the 15% people and the 20% people are paying the largest brunt of this. Your rates actually get better as you put less money down. What? I mean, it makes no sense, right? You're supposed to, like Dave Ramsey's just rolling over right now. I mean, like, he probably can't believe, I don't get, what's going on.
That would be a good show.
That's how new all this is with the thinking, because it's just, it's why it's blown up everywhere. It doesn't make sense, right? So there is a way to, strategy piece here, right? Go in, put less money down so you can get a better rate, come back and recast it, put the rest of the money down later, recast. It's just like you did the loan with the larger down payment, except you didn't get hit with the same rate bump, because when you put less money down, you paid a lower rate. Okay. I'm imagining what sellers will think when they see all these contracts come in with 3% down. Like, what happened to all the people with down payments? That creates a problem. So what do we care who I sell to? If they, as long as they close, right? Well, all right. Loans that are at those lower down payments have more of an issue with the appraisal gap stuff, just so you know. So like when places, which you probably already knew that. Listener, if you did not know that, right.
Less liquid funds to put in.
Right. Or you have room to lower the underwritten down payment portion. So like an 80%, like a 20% down payment might become a 13% down payment because the appraisal came in lower. We don't have to change anything. It's just a rate spread difference, and that can sometimes be massaged out if you know what you're doing. But that's how you get to this stuff that sometimes lenders will talk about gap insurance or appraisal gap insurance or like how they do that. You can't do that on a 3% or a 5% down loan because there's no fat there. So that's where you got to have the buyers that have the extra capital in the bank, right? Well, most of the time when I pre-approve people, and I've had the conversations with them before, is, like, we're not going to put that on the we're not going to put that on the application. I don't want the seller to know that I could pay more than what I'm offering. I want them to think that we're like, this is where we're at. I don't want them to think that I'm, whatever. Like, don't worry about that. When we make the offer, when we put this package together, we're not going to share anything about you that we don't need to share. All right. So sellers don't know that extra powder is in the cabinet over here, in case they need it. So I'm just thinking, like, what would you think? Would this be an issue for you as a listing agent? When all these sellers come out and want you to sell their house for them to these buyers that you've got? Okay.
So you're asking me if my sellers look at, most don't even know what they're looking at.
Well, let's say you get 2 offers in, right?
Okay.
You don't know what their credit scores are. It's not on the contract, right?
Of course not.
But you do know what they're planning on putting down. So let's say it's a 5 offer deal. Okay. You get 2 of them at, one at 25% down, one at 20% down, one at 10, and one at 3, right? Somebody's going to go Home Ready or Home One or Home Possible or something like that. And they're all well-qualified borrowers, let's say, right? All conventional financing. Does that come into play? You as a not you individually,
for me,
maybe. But
I look at that and I present everything. I bullet point all the facts. So sure, this one's offering $5,000 over, but are they going to have trouble down the road because they don't have those funds? So I absolutely always make sure they're aware of what type of loan, what the down payment is to be, etc. I've had a deal where I was looking at multiples with the seller and they really liked this VA contract, but they had one for cash. Yeah. But the one had some terms on inspection and the other one didn't. So they decided to go with the cash, even though they were a VA family themselves. And it ended up burning them because she changed her mind, didn't like the style of the house. That's what it came down to. But it was presented to me in an inspection.
Right.
So, but then the VA buyer was gone once we came back.
Yep.
So we did. We found someone new and we found a better deal, but you never know.
Yep.
It's a risk.
Yep. So I'm just thinking of all the conversations I'm going to have with the listing agents. Like, I know it looks like we're putting a minimum amount of money down, but there's like a benefit to doing that over here, that we've really got more powder here, so that if we come up with some issues with appraisal or with whatever, if you're worried about the quality of the borrower, you're not going to be able to discern that anymore based on the amount of the down payment, because there's external incentives based on what this is now being done in the system here, that you're not going to be able to tell or see. So,
well, for instance, when we purchased our second home, we went FHA because we had been seasoned enough that we could do it again. And we did it because it was cheaper for us,
right?
Not because we couldn't go conventional and couldn't put 20% down, which we could have. But based on what you suggested for us, that's the way we went, and it worked out better for us. Now, in this type of market, we would not be able to do that. We just wouldn't, because no one, it's harder and harder for those buyers.
Yep. Higher rates reduce choices for people. It's like a tax on the system. You're pulling capital out that can't be used for other things. So how do we get a hold of you again?
My cell phone, you can call or text anytime, 573-579-6548.
Okay. And AngieWilder.com.
AngieWilder.com. Angie Wilder sells@gmail.com.
Sellers, if you're thinking of maybe selling, she's got buyers. So
work with someone who knows financing.
Yep. That's the other thing I was going to say. You do well with knowing the financing and working that into the piece. Pleasure to work with you from my end, especially. So appreciate that. HomewiseRadio.com, as always, mortgage website, mine, GoShelter.com. Call or text my phone number direct, local here, 314-275-0314.
That wraps up this edition of Homewise Radio. I'm Stal Ponticus. That's Michael Miget, the creator and host of the show. Angie Wilder, thanks for joining us in the studio.
Thanks for having me, Stal.
Thanks, Angie.
It's been fun.
Nice to meet you.
And we will have another edition of Homewise Radio coming your way next week. Hope you'll join us. Thanks.
Loans and loan information provided by Shelter Mortgage, Inc. Visit us at GoShelter.com and MLS number 192609. A Missouri residential mortgage licensee and equal housing lender. Call 888-497-2558 for additional cost information. Other restrictions may apply.